So an update of our macroeconomic outlook shows that the headwinds we had identified in our last forecast are working their way through the global economy. For example, high inflation caused by the overstimulus of policymakers from both fiscally and monetary policies remain elevated. Geopolitical developments have deteriorated over the last quarter, leading to elevated energy costs, particularly in Europe. And Chinese growth remains sluggish due to COVID lockdowns and a more limited policy flexibility to stimulate their economy. So these headwinds have led to the fastest pace of central bank tightening in decades, contributing to an unusually uncertain economic and volatile financial markets environment for all investors. This quarter forecast is raising the probability of a recession over the next 12 months. That elevated inflation is likely to stick around longer than originally expected, and therefore will necessitate to push unemployment higher to slow the pace of wage growth. So central banks are in a difficult position, having to fight inflation while growth is already decelerating at this stage. This should lead to a global growth deceleration to around 1% for the global economy, but we recognize that the range of possible outcome continues to be particularly wide given prevailing uncertainties. The silver lining is that it is better to tame inflation early and as soon as possible before it becomes more entrenched in the global economy and in consumers' expectation, and avoid a worse economic outcome, even if it creates economic weakness early on. So the risk we had identified in the last quarter remained present. Taming inflation is number one, particularly in the US, and it's a work in progress. Labor demand, for example, is slowing, so there's progress there, but it remains at elevated levels, with jobs open in excess of labor availability. A reflection of deteriorating demographics, the size of the labor force is not growing, leaving the risk of rising wages elevated at this stage. The starting point of inflation is elevated, and central banks will not be able to relax their monetary policy just yet until inflation is on its way back to their 2% targets, which will take a good 12 to 18 months. Ukraine also is a risk that is developing into a longer lasting, unstable stalemate, which could continue to place pressure on energy and food prices. The silver lining again here is that these risks are more recognized at this stage and priced to a certain degree by financial markets. But we must nevertheless manage risk around these events, and we prefer for the moment waiting for clearer resolution before redeploying clients' assets. What's the financial market outlook from here? With continued challenging macroeconomic environment, investors must continue to build well-diversified and resilient portfolio to make sure they can achieve their financial goals. The correction in bond prices makes the forward-looking future return better from here, particularly as central banks continue their aggressive fight against inflation. Fixed income should play also a better role in helping diversify a portfolio than what we have witnessed in the last 12 months. Starting with government bond yields, now close to 4%, bond yields are markedly better than the 1.5% yield that they were offering at the start of this year. Assuming inflation's come down closer to central bank's target over the next 12 to 18 months, investor now can earn a positive real yields that is nominal minus inflation, which is starting to be more attractive. Now, on the equity side, we have also experienced a meaningful correction, and we continue to maintain an underweight, nevertheless, in this asset class for the time being. Most equity markets have so far witnessed a marked decline in valuation in the form of lower price earnings ratio, moving from overvalue to more fairly valued. What is important to assess is how deep the economic slowdown could be to evaluate how earnings outlook will unfold. Here we may see some corporate profit disappointments as analysts continue to revise their earnings forecast lower to account for the coming economic recession. This last leg of adjustment may provide some opportunities for investors, but in the meantime, we continue to recommend keeping a well-diversified equity portfolio with a tilt towards defensive sectors. While we have been recommending holding cash and protecting portfolios, and this has protected portfolios so far, we suspect that opportunities will present themselves over the coming quarters to redeploy this cash, given the expected market adjustment that is developing. Finally, as always, staying the course relative to their long-term plan is always the best advice we can give investors, especially during periods of uncertain economic outcomes.